Fed expected to make another rate cut in September, but with fears of a looming recession, will the Fed look to act even more aggressively? This is the question we keep asking. Steve Liesman joins us now with more, and he's been digging through all of this. Hey, Steve.
I wish I had a more definitive answer, Mona, but Morgan, but the Fed, like investors, struggling to process a series of cross currents in the U.S. and global economies that lead to different conclusions about where to set interest rates. Take a look at some of these cross currents. We have the weak global growth you guys were talking about, but U.S. forecasts remain for, about 2% growth. Bond yields, they suggest a recession in coming months, but U.S. economic data says otherwise. Finally, the consumer thriving while the manufacturing, both globally and in the U.S., may already be in recession.
The U.S. economy is actually in pretty good shape. We're not an island, though, and there's no doubt that as economies in Europe and Asia slow down and go into recession, we can't completely avoid that. But at the moment, I don't see a recession in the imminent future.
All right, here's how the market is pricing the outlook for the funds rate. Unclear if this is more aggressive than the Fed itself thinks where it's going to be. September, 100% chance of a rate cut. We'll talk more about that in a second. 82% chance of another quarter point in October, 56% chance of another quarter point in December, according to the CME. So 75 basis points of rate cuts built in by the market before year end. But now let's look at September, where this idea of being a little more aggressive, a 72% chance of a 25 basis point rate cut and a 28% chance of a 50. That number or that percentage has oscillated between, say, 25 and even as high as 40 in terms of where it is. There's some speculation the Fed could be more aggressive as soon as September. We'll see about that. Now, we'll get a better look. Rick Reeder from BlackRock said this morning that the Fed needs to go 50 because at low rates, each cut has less impact. Fed Chairman Jay Powell made pretty clear that he takes market pricing into account. The recent inversion of the yield curve, brief though it was, will work into his outlook, but so will the strong economic data. And we're going to get a better feel, Morgan, for the Fed's outlook next week in our coverage live from Jackson Hole, Wyoming. Got to tune into CNBC. We're going to have several very special guests. The annual gathering in the mountains taking on more importance now, I'd say, Morgan.
It absolutely is, Steve. And just to give us a little, a little preview here, what are you expecting to hear next week when you go out to Wyoming?
Well, I'm interested in a couple things. I mean, first of all, whether or not the Fed would act, in fact, too steep in the yield curve. I think they've talked about it as something that would keep them from doing things, but I never talked about an idea of actually moving to, say, doing some stuff on the longer end. I think that's one idea. Also, how seriously they take the signal from the bond market is another. And finally, you'll have a lot of international central bankers there. The question whether or not they think they ought to coordinate and avoid this potential race to the bottom. Be listening for that very closely as to whether or not Europe and the U.S. or the developing nations and the developed nations need to work together to figure all this out. While, by the way, Morgan, the political side seems to be fighting and seeing this as a zero-sum game, the central bankers don't.